What's a wash transaction? In the context of the Canada Revenue Agency's CRA Voluntary Disclosures Program, VDP, a wash transaction specifically refers to a situation involving GST/HST. It occurs when a supplier sells goods or services that are taxable to a recipient who is a registered business or a registrant. The supplier fails to correctly charge and collect the GST/HST from that registrant. Crucially, if the tax had been correctly charged and collected, the registrant would have been entitled to claim a full input tax credit, ITC, for that same amount. In essence, no actual net tax is lost by the government, because the recipient would have simply claimed it back as an ITC anyway. The funds would essentially wash through the CRA system. Examples of wash transactions. A wholesaler sells goods to a retailer but doesn't charge GST/HST, assuming the goods are zero rated. An audit later determines the goods were taxable, but the retailer would have claimed a full ITC anyway. Within a closely related group of businesses, GST/HST is collected and remitted by the wrong entity, or ITCs are claimed by the wrong entity, but all parties are engaged exclusively in commercial activities and would have been entitled to full ITCs. When a disclosure involving a wash transaction is accepted under the new VDP rules, it may be eligible for full penalty and interest relief. This is because the error did not result in a net financial loss to the government. It is important to note that the term wash sale, in a different context like investing, can refer to selling a security at a loss and repurchasing a substantially identical one within a specific time frame to claim a tax loss. Important to remember, the CRA's VDP wash transaction is specifically about the GST/HST scenario described above, and not for any intentional reasons to avoid paying GST/HST.